as we've been hearing, the latest monthly inflation figures show that inflation is up. And economists are saying it would have the Reserve Bank of Australia tipping more towards a rate hike. Not what many people wanted to hear. The RBA has hiked rates 13 times since May 2022, and the official cash rate is now at 4.35%. But what does inflation rising actually mean for your budget? And how likely is it that another rate hike will be a reality and cause your mortgage to get higher? To answer those questions, we're joined now by Leith Van Onsen, who is the Chief Economist and co-founder of macrobusiness.com. Hi, Leith.
G'day, Sarah. Thanks for having me on.
My pleasure. So we often talk about inflation. I think a lot of people's eyes might glaze over. I know yours don't. This is your business. What can you tell us about this inflation data in terms of what it actually tells us?
Yeah, look, it obviously wasn't a great print. So it's important to note from the outset that the ABS releases two inflation prints. So one of them is the monthly inflation indicator, which is what we got yesterday for May. That is less comprehensive. It's sort of like a quick read on the inflation numbers that we get every month. The more comprehensive quarterly inflation number, so that's for the June quarter, will be released on the 31st of July, and that's the one that the Reserve Bank's going to be looking at far more closely, because that'll give the inflation over the entire quarter, not just the first 2 months. And it also includes a whole bunch of other measures that aren't included in the monthly one. So it's a more comprehensive read. Yesterday's print was obviously not good. So we had an inflation rate of 4% over the year, which was worse than what economists were expecting. So economists tipped 3.8%. So it's obviously not a great read. And the thing that the Reserve Bank's going to look at more closely is what's called the trimmed mean inflation. So that's basically where they, it's called underlying inflation. It's where they get rid of the most volatile components like petrol prices, for example. And that actually rose to 4.4% over the year, which was obviously higher than what the Reserve Bank would want. But as I said, the Reserve Bank's going to focus more closely on the Q2 inflation numbers on 31st July. They also will get a labour market print, so that'll give us the unemployment rate mid-next month. And there's also two retail sales data releases to come out between now and their next meeting on the 6th of August. So they'll wait for all that data to come in before they make a decision on interest rates.
Okay, so we've got to wait for a bit more information there. It's interesting that inflation has gone up in the sense that everyone you speak to tells you about how they're reining in their spending. Their pockets just aren't as deep. So what is driving the inflation figures?
Yeah, so there's a few things there. It's important to note that that the Reserve Bank of Australia's interest rate hikes really only impact around 1/3 of households. Now, that's sort of the belief, but effectively 1/3 of Australians have owner-occupied mortgages, and they're the ones who get absolutely hammered by the interest rate hikes. We have roughly 1/3 of Australians rent, and 1/3 of Australians own their homes outright, and they don't rent and they don't have mortgages. So effectively, the Reserve Bank is relying on a very blunt tool, which is interest rates, a single tool, to hammer 1/3 of households to try and get the overall inflation under control by smashing demand in the economy effectively. So it's not a great tool to do it. And so we have this situation whereby if you're a homeowner with a mortgage, you're under heaps of financial pressure. The same applies with renters, because obviously rents are rising very quickly, which is actually feeding inflation, and that cohort's struggling. But then we have 1/3 of households who own the homes outright who aren't really feeling the impacts, and they tend to be the ones who actually doing most of the spending as well.
Yeah, so and what's the spending going on? Is it not the sort of discretionary stuff, the new pair of trousers or the restaurant meal out? Is it things we can't avoid, like insurance going up and petrol, as you mentioned?
Yeah, mostly. So we have seen quite a decent decline in what's called discretionary spending. So that's the stuff they're basically things you want, but you don't necessarily need. Unfortunately, most of the spending is going on essential items. So non-discretionary, so that's things like rent and energy and insurance payments and those sorts of things. Obviously food, petrol, that's basically where most of the spending is going. And unfortunately, interest rates aren't a great way to control those sorts of things because people must spend on them.
That's exactly it. So we can all say, pull your heads in, you're helping inflation go up, but we can't pull our heads in any further. We're only spending on things we absolutely have to. With that in mind then, are interest rates the best way for the Reserve Bank to, I guess, try and bring down inflation, get this back under control?
Yeah, unfortunately, the Reserve Bank only has one tool, which is interest rates. And really what we need for the federal government to step up, because the federal government has a whole bunch of levers that it can pull. to get inflation under control. Unfortunately, they're not willing to pull it.
What
So
are those
I'd argue-
levers? What sort of things could they do?
Well, unfortunately, they're not very popular, and often when I suggest these, I get tomatoes thrown at me. But the first and foremost is they need to cut immigration very hard because they're running a near-record immigration policy at the same time as we can't build enough houses for a whole variety of reasons. And that's the reason we have this really strong rental inflation. So rents are going through the roof. And that's actually one of the main drivers of our inflation. The other area where we really need the federal government to step up is energy. So for some crazy reason, Australia is an energy super. We have oodles of gas and coal and everything. Yet on the east coast of Australia, we're actually paying some of the world's highest energy prices. And that's because the federal government didn't bother to reserve our gas for domestic use when it improved a whole bunch of export terminals in Queensland. So effectively, we're left in this situation whereby we export 2/3 of our gas internationally at the same time as we pay some of the highest gas prices in the world domestically, and we have an artificial domestic shortage. And that gas price is then feeding into electricity prices, which has meant that we've got really high energy prices in Australia, and that feeds into inflation across everything. So we really need the federal government to step up and, slow the immigration down and also fix the energy market, because those are two of the main drivers of Australia's sticky inflation problem.
The gas prices we pay here, you say, are high because it sort of goes into the overall global supply. Would people be paying less money for Australian gas overseas than we're paying for our own Australian gas here?
Yes, unfortunately that's the case. So we actually pay higher gas prices domestically on the East Coast than they pay overseas. It's a crazy situation. And just as a counterpoint, Western Australia has a separate gas market because it's not linked via a pipeline. And Western Australians pay some of the lowest gas and electricity prices in the world because their government was sensible enough to reserve gas for domestic use. So Western Australia actually exports over 80% of their gas. However, their government required that a 15% of export gas is reserved for domestic use. And what that's basically done is it's supplied Western Australians with plenty of gas. It's kept prices very low, and a low gas price means a low electricity price. And we effectively need the federal government to do the same thing on the East Coast, because East Coast Australia is the only place in the world that exports gas that doesn't have a domestic reservation policy. And as a result, say residents of the United States pay $4 a gigajoule in Australian dollars for their gas, whereas last Friday we were paying $25 a gigajoule on the East Coast for our gas. And yet we are one of the world's biggest exporters.
That's a stark difference. As you were saying, though, the government is hesitant to change any of those levers you say they could pull. I'm wondering, if we go back to interest rates now, if you were on the board of the Reserve Bank of Australia, would you be leaning towards another rate hike after reading the inflation figures we've got this week?
Look, I'd personally be waiting for the data. So obviously the chances of a rate hike have gone up after this release. I'd be crazy to say it hasn't. However, the Reserve Bank has to balance not just inflation but also the unemployment rate. So it has basically two key performance indicators. It's got to keep inflation within target, and also it's got to aim for full employment basically. So what the Reserve Bank also needs to look at is the May labour force release that will come out mid-next month, as well as retail sales, which outside of the pandemic they've been tracking at the lowest level since the early 90s recession. So the consumer economy is very weak. The economy overall is weak, especially once you strip out population growth. And I think the Reserve Bank just needs to see how the data falls and then make its decision once the next set of data releases come out.
I know it's a cliche, but we really are in a bit of a waiting pattern at the moment. Leith, it was great to chat to you this afternoon. Thank you.
Yeah, thanks, Sarah. Anytime.
Thank you. Leith Van Onselen there, the Chief Economist and founder of macrobusiness.com.